Namaste to all. I welcome you all in this next webinar series hosted by the Accounting Standard Board of ICI. We are having regular webinars on a monthly basis, at least two we are having on various standards and frameworks. But currently, what we are having is the Do You Know series, specifically on the financial statements for the non-corporates and the LLPs, that is the proprietorship partnership and the limited liability partnership. In the last two series, in the first series, in this third Do You Know series for the financial statements, we are having a discussion today on the income and the expenditures for the proprietorship partnerships and the LLPs. Friends, we all know that now currently the financial statements are for the non-corporates have been mandated by the ICI. The new formats are there. Many of the preparers are preparing those formats, of which the Excel sheet is available on the Accounting Standard Board's website. Also, the past two discussions on the Do You Know series, they are available on the ICI TV as well as the ASB website, as well as also on the YouTube. So anyone who has not gone through the earlier sessions, they can go and view that. And also this one, it would be available. It would be available again on the ICI TV as well as the YouTube. For the discussion today on the income and expenditure sides for the financial statements for the proprietorship partnerships and LLPs, and basically all non-corporates, we have two of our very eminent panelists out there. One is CA Rajesh Kumar Jain ji, and second is CA Bhavesh Gondia ji. Bhavesh ji is a regular faculty for our INDAS course. He has got more than 10 years experience and has been effectively contributing to the ASB over the past several years as a faculty also. And Rajesh Kumar Jain ji again is a very seasoned experience, having more than 30 years of experience and into accounting and the taxation field, and has been the past chair of the Ludhiana branch. Also done a few certificate courses, including the INDAS course, and most importantly, he has been one of the instrumental member in formulating the guidance note for the non-corporate and the LLPs. So his contribution to that has been effective. In fact, the last two sessions, he had been the moderator for asking questions. Now today, he will be the job of answering the questions which would be asked. So our reversal. Welcome, Rajesh Bhai today, and thank you for again contributing regularly to the board, to the ICI, your own fraternity. Thank you. And to moderate these two stalwart panelists, we have got CA Nitika Khewani ji, who is not new to all of you, who have been contributing regularly to the various boards of ICI, and have been not only was also the part of this group who had prepared this guidance note for the framework for the financial statement for the non-corporate and LPs. She was a very prominent part. And today she would be asking the questions to two panelists. So over to you, Nitika, to start the session.
Good afternoon, everyone. I have a little technical glitch on my camera, but I think it should start in a few minutes. Thank you, ICI, for giving me this opportunity to moderate the session. And of course, nothing better than a guidance note, which I have been a part of the same. So beginning with Bhavesh ji. So if you could please begin with explaining how are the terms income and expenses defined in this framework for the preparation and presentation of financial statements issued by the ICI?
Yes. Good afternoon to everyone, panelist, our Pramod sir, moderator, and all the participants who are joining this webinar for the income and expense. As it's a very good question, initially to start with, income and expense, how it is defined. Like as and when we have seen this financial statement, it has been under the shadow of accounting standards. So I would say, like all accounting standard is telling something, like in a inverted comma, I would like to make one statement that a specific transaction, specific treatment. Each and every standard is talking about specific transaction, specific treatment. So for income and expense also, many of the standards like AS7 is told about construction revenue. AS9 is talking about a particular type of revenue. For recording the cost, we have a different type of standards. So first priority is that we have to refer to the particular accounting standard for a particular treatment. Again, I am repeating, for a particular transaction, particular treatment that has been specified under our accounting standard that we are supposed to follow. But in many cases, sometimes it is not possible to address with the help of a particular standard. Then this format of financial statement has also given some recognition criteria for income and expense. As we have learned in our 11th and 12th standard talking about rules and everything, but this type of rules are being redefined in a different format. Like if I say that recognition of income, they say that whenever there is an increase in any economic benefit, which results in an inflow of assets or decrease in liability. So any income which is giving you an economic benefit, which would result in increase in asset or decrease in liability, this is the general rule that you are supposed to follow for the recognition of income. Coming towards the expense, which talks about a decrease in the economic benefit, which results in an outflow of asset, that means a payment of cash, bank, or whatever it would arise, or increase in the liability, that you are supposed to follow a recognition of expense. So income and expense recognition criteria are being given under the guidance note. But again, I am repeating, first you are supposed to approach to the relevant accounting standard for the recognition of income and expense. After that, if it is not possible, then may you refer it to the general criteria which are being mentioned under the guidance note of the financial statement, which is one for income and one for expense. Increase in the economic benefit, expense would come decrease in the economic benefit, followed with the asset and the liability rules. So these are your terms, income and expense, which are being defined for the framework of the preparation and presentation of financial statement. Over to you, ma'am.
So over to Rajesh ji, who can now take us through what are the criteria for recognition of income and expenses in the AS or the framework, and under what condition the criteria and framework is to be followed for recognition of income and expenses.
Good afternoon, everyone. First of all, I would thank CA Pramod Jain ji, Chairman, Accounting Standard Board, for giving me this opportunity to be part of this Do You Know series on the financial statements for non-corporate entities and LLPs. In the first webinar on assets, I was the moderator. Then again, on the second webinar on liability side of the financial statement, I was a moderator. Today, I have been given the opportunity to be a panelist on the income and expense. As regards your question on what are where the criteria for recognition of an income and expense has been prescribed, whether in the AS or in the framework. As we all know, the different accounting standards lay down recognition and measurement principles and the disclosure requirements for different items of profit and loss, like depreciation is covered in AS10, revenue recognition is covered in AS9, and construction contract 7, like that. But the original or the basic criteria for recognition of income and expenditure in these standards is governed by the framework for the preparation of financial statements issued by ICAI. According to this framework, income is recognized in the statement of profit and loss when there is an increase in economic benefits related to increase in the assets or in decrease in the liability, as has already been discussed by Bhaveshi. This way means that the recognition of income occurs simultaneously with the recognition of an increase in assets or decrease in liabilities. As for this income recognition criteria laid down in the framework, it restricts as income only to those items that can be measured reliably and have a sufficient degree of certainty. Unless these two criteria regarding the reliability of measurability of the income or the with sufficient degree of certainty is missing, then you cannot recognize that as an income as per the framework. Again, the expense is also from the framework, expense is also been defined in the framework as the decrease in future economic benefits related to decrease in an asset or increase of liability. But certain expenses are recognized in the statement of profit and loss on the basis of a direct association between the costs incurred and the earning of specific items of income. This process is generally, as we all know, is referred to as the matching cost with revenues. An expense is also recognized immediately in the statement of profit and loss when an expenditure produces no economic benefits. As we have already learned that if it is an increase in economic benefit, then it has to be treated as an income. But if any expenses does not result in future economic benefit, it is to be treated as an expense. This is all on the from framework on income and expense.
And sir, okay, I think Bhavesh ji can answer this. Is there any criteria for rounding off of figures appearing in the financial statements? Does this guidance note tell us something about the rounding off of figures?
Yes. Actually, the format of the financial statement, no, talking about non-corporate entity. So, no, many of the time we see these are the small entities, but not. These are considered to be a big entities. That is why importance is being levied. So, considering that criteria also, the numericals are being divided into two parts. Like your financial statement is having less than or equal to 100 crores in terms of the amount, then you may round off. You may round off your entire financial statement nearest to 100, nearest to 1,000, nearest to lakhs, or nearest to millions. Like sometimes it happens that your highest number is 5 crores. So you may go with the thousands. But if it is 90 crores, then you may round it off to lakhs or a million. It would be easy to read out the number. It is like coming at the cost of the comfort to read the amount. That is why less than 100 crores, you have four options to adopt, either nearest to 100, thousands, lakhs, or millions. But if the total value is 100 crores or more, then you have three options to round it off. One, either in terms of lakhs, millions, or crores. But you are supposed to take care one important factor, that once you decide that this is the nearest number which I would like to convert my entire financial statement, like in terms of lakhs, then it has to be uniformly used entire financial statement. That means you cannot round off your P&L with lakhs and balance sheet with millions or in crores. So that unit of measurement has to be uniform throughout your entire financial statement. Considering these two criteria, less than 100 crores, then you have an option of 100, 1,000, lakhs, and millions. If the value is 100 crores or more, then you have three options: lakhs, millions, and crores. Over to you, ma'am.
So you mean to say that we are in line with what has been told as per the Companies Act?
Yes, in line with the Companies Act.
So going forward, I think there won't be any difference in how we disclose our financial statement for corporate entities and non-corporate entities.
Sure, ma'am. That is the motive and the intention of our ASB also, not to make non-corporate and the corporate also in line.
Yeah. Rajesh ji, are there any recommended minimum requirements for disclosure on the face of balance sheet and the statement of profit and loss? And is it in line with the line items, subline items, subtotals, or anything that may be outlined in any other section?
Yes. This guidance note has already set out a pro forma containing the line item, subline items, and subtotals for the financial statement, which contain the balance sheet and the statement of profit and loss. But the line items, subline items, and subtotals shall be presented as an addition or that means with change or substitution on the face of a financial statement, when such presentation is relevant to the understanding of the non-corporate entity's financial performance or position, or to cater to industry-specific disclosure requirements on when required by compliance with the amendments to the relevant statutes or under the accounting standard. Sometimes there is a change in the statute, or there is something differently requirement of an accounting standard. Then these line items, subline items, and the subtotals should be changed to align with the requirements of the accounting standard. Or when there is a change in the statute, these line items, subline items, and the subtotals should be presented in such a manner that it is useful for the user to understand the financial performance or financial position of the enterprise. The disclosure requirements specified in the formats are in addition to. These are in addition to and not in substitution of the disclosure requirements specified in the accounting standard issued by ICAI. Additional disclosures specified in the accounting standard should be made either on the face of the financial statement or in the notes to accounts or by way of additional statement, unless required to be disclosed on the face. Similarly, all other disclosures as required by the relevant statute, like income tax, require something to be disclosed in the financial statement, that should be made into the notes to the financial statements in addition to the requirement as already set out in this format. You see, this format has been derived in such a way that there is a very little difference between the format for the corporate entities prescribed by MCA and the non-corporate entities prescribed by the Institute or ICAI through this guidance note.
Yeah, the idea is to disclose as much as possible so there is more and more transparency, and it is easier for the user to go through that what exactly the financial statements hold for him. Bhaveji, if you could also let us know about the format of statement of profit and loss.
Yes, ma'am. Now, looking toward the non-corporate, no, we have seen a galaxy of designs which are available in the format. Like people write in the manner in which they are easily understandable to themselves, not to the others, considering the other stakeholders also. So sometimes no, it becomes very difficult to read out their terminology also. See, that is why this format would give a transparency. It would give a consistency also. It will give comparability also. That is the sole motive of our accounting standard and the preparation of the financial statement. So they say, so like we are not going to change the numbers of the financial statement which are being prepared by the sole proprietor or those people. We are just making them to convert their financial statement in a specific format. That your income is 1 crore. Yes, take that 1 crore, but we will tell you where that 1 crore to be placed specifically. You have a varieties of expense. We will tell you that this expense has to be classified under this head. This expense has to be classified under this head. And everybody has to follow the same principles. So this format will give an easy reading of the financial statement, which was not available in the other format of the financial statement prepared locally. So the main objective here is to bring all items of the financial statement, wherever it is located in their accounts, to a specific location, which is uniform for everybody, So if you permit me, let me share one Excel sheet which has been given by the ASB for the format of the financial statement.
And I think it is available on the SSP portal as well for the users to download.
Okay. Yes, ma'am. This format is visible?
Yes, sir, it's visible.
Yes. So now if you can see the first part, no, revenue from operation and other income. So this is nothing but I can say it is your credit side of the P&L. It is our credit side of the P&L, considering sales,
Yes,
considering other income. We will take it in detail as and when the more and more question would be elaborated
Yes,
from
sir.
your side. But as
Yes,
just an overview, we can say this is your credit side. All expenses which we have, it is your debit of the P&L, debit of the trading and the P&L account. Then specifically little bit, some exceptional items are being highlighted separately. Same way, extraordinary items are being highlighted separately. Tax expense also to be recorded separately on a specific location. Same way, you will get your final profitability from continuing operation, as well as there is one another head, which is your discontinuing operation. Any of the unit which you have discontinued during the year, it has to be given separate details. So on a broader view, we can say all items of your accounting is being specifically located in a particular format. That is your this Excel sheet that we are supposed to follow, which are being given by our ASP. Over to you, ma'am.
Thank you, sir, for taking us through. Rajesh, sir, how should we disclose revenue from operations under the notes to accounts of a non-corporate entity vis-a-vis that of a LLP? And are there any additional disclosures that are required in case of a non-corporate entity?
As you have already gone through the Excel sheet of the statement of profit and loss, the first item, the first, and in fact, it is the most important item of any financial statements, revenue from operations. Revenue from operations for a non-finance company means which is a manufacturing company or a trading company, which is not into the financing activities or an investment activities. It should be disclosed separately in the notes as revenue from sale of products. Sale of products means sale of finished goods, sale of traded goods, or any other goods dealt in by the enterprise. It should be disclosed at the gross value, less excise duty component included in the sale of products should be deducted to arrive at the net amount of the sale of products. Then the second line item is the sale of services. Revenue arising from sale of services should be disclosed separately. And apart from it, there are certain other operating activities which unit carries on. That activities which are neither sale of products nor sale of services, that should be clubbed into the residual head, the other operating revenues. Like interest and dividend income should not be included in other operating revenues. In case of a finance non-corporate company which deals in financing activities, oblique LLP, the revenue from operations shall include separately revenue from interest and revenue from other financial services. This is the this should be disclosed in the notes. On the face of the financial statements, sale of revenue from operation should be disclosed, and in the notes detailed about sale of products, sale of services, and revenue from other operating activities should be disclosed separately.
Are there any specific criteria to disclose these income from operations and other income?
Yes, ma'am. In case of other than finance non-corporate entities, revenue from operations include revenue arising in the course of ordinary activities of an enterprise from the sale of goods and or from the rendering of services. Means any activity which is ordinarily being carried out by the enterprise, any revenue arising from that activity should be disclosed here. Revenue from operations include also the other operating revenue, such as sale of scrap, export benefits, etc. Revenue from operations has to be recognized according to the accounting standard revenue recognition. AS 9, revenue recognition, contains some examples of items which are not to be included with the definition of revenue for the purposes of this standard. these kind of items which have been specified in the accounting standard should be included in the other income. This is the basic difference between revenue from operations and other income. Basically,
So if you could also enlighten us on certain examples of
yes,
other income.
yes, ma'am. Basically, other income means gains arising in the course of activities other than the ordinary activities of the enterprise. Interest income, because in earning of interest is not an ordinary course of business. Dividend income, rental income, other non-operating income, which could be like gain on disposal of investments. These are not part of revenue for a non-finance company. Gain on disposal of investment is not a part of revenue from operations. It is a part of other income. Other miscellaneous income can also be there, which is to be included in other income, like subsidies from government, gain on disposal of property, plant and equipment, gain on foreign currency transactions and translations. In fact, the basic criteria for distinguishing between revenue from operations and other income is whether that item is generating in the course of ordinary activities of the enterprise or in the course of activities other than the ordinary activities of the enterprise. Over to you, ma'am.
In this, continuing with this question, like for non-corporate entities like proprietorships, in case I have a salary or an interest income coming in, which is coming to my personal account, so is that to be credited to P&L also?
No, ma'am. Actually, we are talking about the enterprise, non-corporate entity. In proprietorship, concern is altogether separate from the proprietor. Income in his personal nature, like salary income of the proprietor, interest from his saving account, recurring account, fixed deposit accounts. If these fixed deposits are carried in his individual name, that should not form part of the financial statement of the proprietorship concern. Income from mutual funds, income from shares in his personal and of the proprietor, these all should not be credited to the profit and loss account of the proprietorship concern. Proprietorship concern, profit and loss and the balance sheet should contain only those items which are related to the business of that proprietorship concern.
Right, sir. Because a lot of times we consider that since it is on a pan of assessee, so it should be disclosed in the financial statements as well.
This used to be there used to be different formats. In fact, the saving account, mutual funds, all these items of individual name used to be carried in the financial statement of that enterprise. But now onwards, since Institute has come out with a guidance note on the non-corporate entities, from this day onward, from 1st of April 2024, we have to follow this guidance note as auditor also, as a preparation of preparer of the financial statement also. We have to follow this guidance note, and in that case, any item which is in the personal income of the proprietor, like salary, interest on FDS, these cannot be credited and should not be credited to the profit and loss account of the business enterprise of the proprietor.
Right, sir. So basically, this guidance note helps us to clear the air.
Yes, ma'am. Clear the balance sheet of those proprietors who carry their mutual funds investments in the financial statement. And it is when these kind of items are carried in the financial statement, it also becomes difficult for the auditors also, because they are basically
yes, because it becomes a hodgepodge account. Everything
Yes.
coming to the credit comes in the financial statements.
Yes, because in that case, those financial statements are driven by the 26 AS or the TIS or AIS. But our financial statement should not be linked or related to the annual information which is contained in the AIS or TAS, but it should be related to the business income, business of that assessee, whether it is in manufacturing, trading, or rendering of services.
Thanks. Bhavesh, coming to the cost part of it, how is finance cost classified in the notes to accounts of a non-corporate entity and LLP?
Yes. Now, coming toward the finance cost, no, a proprietor and a non-corporate, no, is generally been under the identity of unstructured and unformat way of doing business. So many of the time, no, they approach for banks, they approach for the unsecured lending also. So now the important part would come about expense. They have further divided into 2-3 parts. Like one is your, if you take a loan from a bank, CC, term loan, and whatever the interest component that will come, that will fall under that part, as well as now accounting standard 19 is there, which we have a lease. Under that, we have a finance lease also, wherein we are supposed to bifurcate that financing component, which is also been termed and identified as interest. So that does not only mean that interest paid to banks would only be a finance cost. Even in line with the accounting standard 19, we have finance lease, where also when you extract that finance lease component, under that we have a finance cost that also will be identified as an interest expense. Along with that, even let's refer to the AS11, that we have a foreign exchange. Under that foreign exchange also, when we translate our monetary items, which would also result into your exchange loss or a gain. If it is an exchange gain, then that translation of that foreign currency into the reporting currency would also form part of your finance cost. And as well as some other ancillary cost related to the borrowings, that also you may write it in your or debit to that particular head, which is your finance cost. So in a nutshell, let me summarize that your interest expense would be, one thing is from banks, other AS19, where you have a finance cost, AS11, that is your foreign exchange loss, and as well as the other borrowing cost that we are supposed to present and given a details under the finance cost head, subhead interest expense. Over to you, ma'am.
So then, is it to be disclosed as a separate line item? Say
Yeah,
I have a foreign currency net gain or loss.
yes.
So should I club it in the finance cost or should I disclose it as a separate line item?
No, as a separate item under the finance cost head. But you may do it net. Like in one transaction, you have a gain, other transaction, you have a loss. So you may do it net of that gain or a loss and you may present it.
Okay.
But it has to be done separately.
Right. Basically, I make a group of finance cost and I give it a separate subline item.
Yes, ma'am. Yes, ma'am.
And so how do we classify the employee benefit expenses in the notes to accounts?
Okay. So now see, under the employee benefit also, we are supposed to check upon that which all are the expense that would fall under the employee's benefit. Because see, the word employee, that does not mean only restricted to the salary. So we are making so many payments to the employees. So which all are the payments that would fall under the employees that would result into your employees benefit expense. So let me first take up the certain amount of list. Like you have salaries, you have wages, you have bonus, contribution to the PF, gratuity,
We have gratuity,
staff welfare. All this will form part of your employees benefit expense. That you are supposed to show it separately. Like how you have asked about a foreign exchange gain or a loss. It is a separate line item. Same way, which are the names which I have elaborated, all has to be shown separately under the head, and the disclosure may be provided if it is exceeding certain limits.
Right.
Over to you,
so are the limits also defined or is it left to our own professional judgment that this is how we should do?
Not that a stringent limit is available, but if like certain expenditure is exceeding 1 lakh to a particular person, then you may address it. But there is no such, but a bifurcation has to be given under each head separately.
Rajesh, so what are the criteria for disclosing any item of income or expenditure, whether they have to be disclosed as a separate line item in the notes?
Thank you, ma'am. As per the general instructions in the guidance note for the preparation of profit and loss, any item of income or expenditure which exceeds 1% of the revenue from operations of that enterprise or rupees 1 lakh, whichever is higher, should be disclosed as a separate line items in the notes. That means if any item which is 1% of the revenue, more than 1% of the revenue, or 1 lakh rupees, whichever is higher, that should be taken into a separate line items in the profit and loss, whether on the face of the profit and loss, or if it is face of the profit and loss, if it is so defined in the pro forma or in the notes to the financial statement. Apart from it, there are certain items of income and expenditure which shall be disclosed by way of notes to the financial statement, to notes to the profit and loss account regarding aggregate expenditure and income on the mentioned line items, which shall be dealt by CA Bhaveji, for which you can raise the relevant question to Bhaveji for going through these notes regarding aggregate expenditure and income on the mentioned items.
So I think you have clarified and raised the question yourself. I would not like to come in between. Bhaveji can carry on from your question.
Yes, ma'am.
So on the specific information required with respect to aggregate income and expenditure,
Yes,
what
now,
disclosures do?
yes, Rajesh sir has correctly told about and very nicely elaborated about that 1 lakh rupees of limit, no? That is been there in the notes to account that you are supposed to address, as well as earlier question also you asked about an employee's benefit, that also would be available. Or sometimes there is an some diminution in the value of investment, which you are
Yes.
supposed to reduce it. That also to be provided. A foreign currency loss, exchange gain or loss, that also has to be provided in the notes to accounts. In line with the exceptional items also, sometimes it happens. So that specific head is available on the face of the P&L. Along with that, notes to accounts also has to be provided separately. Even a prior period, sometimes in the last year, you forgot to book certain amount of expense or income that may fall in the current year for booking, that also to be addressed separately for the notes to accounts. And in this design, there are some 6-7 lists which I have highlighted separately are available for your particular question. Over to you, ma'am.
Rajeshji, with respect to specified items, what are the requirements for disclosure for the expenditure incurred? Or if you could also provide us guidance on the disclosure with respect to presentation as a separate line item.
Yes. As Bhaveji have already shared the Excel sheet, which is also available on the website of the ASB.
Yes.
This performa is more like a corporate entity which starts from revenue from operations and other income, then total income. This is the credit side of the profit and loss account with comparative figures for the previous year. And the expenses starts with the cost of material consumed. The second line item in the expenditure side is purchases of stock in trade, then changes of inventories of finished goods, work in progress, and stock in trade. Then next is the group is employee benefits expense, finance costs, depreciation and amortization costs, then other expenses, which is the residual cost. Then total of expenses. From this total income and total expense will arrive at our profit or loss before exceptional and extraordinary items and partners remuneration and taxes. Then we will reduce or add exceptional item. Then we'll arrive at the profit or loss before extraordinary item and partners remuneration and tax. From this figure, we'll add or reduce the extraordinary item and then partners remuneration and then tax, and we'll arrive at the net profit for the year. As regards all these items are to be disclosed in the notes. The relevant figure will be derived from the notes to the statement of profit and loss. The face of the profit and loss will contain only the aggregate amount in the notes. We have already dealt with how the revenue from operations and the other income is to be disclosed. As regards other items in the expense, we have already dealt with the credit side, that how the revenue is to be disclosed, what are the contents of revenue from operations, and what are the contents of other income. As regards the expense side, the first line item in the profit and loss statement is the cost of material consumed. In this material consumed, we have to give the consumption of raw material and the consumption of packing material if it is a part of raw material, and the other items which are part of material. For this, we have to give the reconciliation. Reconciliation means starting with inventory at the beginning of the year, purchase of that item, whether it is raw material or packing material during the year, less inventory as at the end of the year. The residual figure will be the cost of material consumed, which will include raw material, packing material, and other materials. This is with regard to the cost of material consumed. The second line item is the purchases of stock in trade. This is as simple as the name suggests. Purchases of stock in trade at cost should be disclosed in the statement of profit and loss account with cross reference to notes if it is available. Otherwise, straight away the line item can be used to disclose this purchases of stock in trade, because it is a simple line item. It does not contain, purchases are simple at cost. It does not contain the opening, it does not contain the closing inventory. It is a single line item which can be directly taken from trial balance and disclosed in the statement of profit and loss. The next item in the profit and loss statement is the changes in inventories of finished goods, work in progress, and stock in trade. For this, we have to give the line item closing stock of inventories less the inventories at the beginning of the year. The resultant figure will be the changes in inventories of finished goods, work in progress, and stock in trade. This net result will be taken from notes to the face of the financial statement, that is statement of profit and loss account. Then the next item is the employee benefits expense, which has already been dealt by Bhavesh. Then this will include the salaries, wages, bonus, and allowances, and a separate line item for contribution to provident fund and other funds. Another line item within employee benefits expense is the gratuity expense, the staff welfare expenses. The total of these, all these line items will be carried to the face of the statement of profit and loss. Then another item is the finance cost, which has already been partly dealt with by Bhavesh. These interest expenses, interest from interest paid to banks on loans, interest on lease finance, interest to partners capital, other borrowing costs, losses on foreign exchange transaction and translation considered as finance cost as per AS 16. These are to be disclosed separately, and the total of all these finance items will be disclosed in the notes, and the total will be carried to the face of the financial statement. And the residual clauses, other expenses, all other expenses which had not been dealt with priorly, like material consumed, employee benefits, interest expense, all these be disclosed separately. Depreciation and amortization will be disclosed separately on the face of the statement of profit and loss account. Then other expenses, there is a list of other expenses as per the guidance note, but this is not an exhaustive list. This is only a sample list which contains consumption of store and spare parts, power and fuel, rent, repairs to building, repair to machinery, and other miscellaneous items like traveling expenses, printing and stationery, legal and professional advertisement. All these are other expenses. This is a residual clause. These expenses should be taken in the other expenses account. For this, guidance has been given that any item which is any item of expense which is 1 lakh rupees or 1% of the revenue from operations of the enterprise, whichever is higher, has to be disclosed as a separate line item, and that too in the other expenses. Then this total expenses will be carried out to the statement of profit and loss. Now, all these expenses shown on the statement of profit and loss should be cross-referenced to the notes to the financial statements. Over to you, ma'am.
Yeah, sir, like you already set a criteria of 1%, 1 lakh. So anything which is not fitting into the criteria will go into other expenses, and the other items that are coming up above 1 lakh or more than 1% will definitely be disclosed as a separate line item.
But no, other expenses is not basically it is
No, not necessarily other expenses, but yeah, the expenses which we do not need a separate line item for.
yes. Like material consumed, we have already dealt with.
Yes.
Purchases of stock and trade, we have already dealt with. Changes in inventories from opening to closing, we already dealt
Yeah.
with. Depreciation is a separate line item. Employee benefits as a separate line item. And if finance cost is a separate line item. Any item other than these items which we have discussed, these are to be clubbed under other expenses. Within that other expenses, there are separate line items like legal and profession and all that. But for these separate line items, there is a guidance that any item which is 1% of revenue from operations or 1 lakh, whichever is higher, has to be disclosed separately within this other expenses.
Yeah. Right, sir. Bhaveji, what is the treatment of following items in the statement of profit and loss account, like short provision for bonus or provision for income tax relating to earlier years, or say investments write-off? We did discuss at a point of time that there's been a diminution of value. But so how are these items disclosed in the profit and loss account?
Yes, ma'am. What is the third point, ma'am? You told the third point?
Investments written off.
Okay, okay. So I hope your question is talking about a particular treatment for the following
Yes.
three items.
How are these
Yes.
items treated in a
Yes.
profit and loss
So
account?
like number one, as you told about the short provision for the bonus, no? So short provision for the bonus, like bonus generally we pay to the employees. So as and when that payment would be made, it would be classified under the employees benefit in the year in which the payment is being made. So for this particular, we have to refer to the employees benefit. Under that you may provide it, provided it is paid. In the year in which it is paid, we may write it in that particular head. Coming toward the second point, which is the provision for the income tax relating to the earlier years. So now, in the last year, you might have provided some of the tax, but when the assessment is done, actual liability has arisen, and you came to know that you are supposed to pay something more. Like assume that in the last year, you have provided a tax for 1 lakh rupees. In the next year, actual liability on the basis of the assessment done by the income tax officer has came to 1,20,000. So 1 lakh I already provided. Question in front of us about the treatment of that 20,000, that we name it as provision of the income tax relating to the earlier years, where that 20,000 would be reflected in your statement of the P&L. Ma'am, if you permit me, let me go to that Excel to give more clarity on that. Is it Excel is
Please,
visible?
sir. Not yet.
Okay. Let me share it once again. Is it visible now?
Yes, sir.
Yes. So your 20,000 in our case would be reflected here. Can you see the star mark? Excess
sir.
or a short provision of the tax relating to the earlier year, you may write it on the face of the P&L here as 20,000.
Right, sir.
Is this 20,000 is visible, ma'am?
Yes, it is.
Yeah. So this is your answer to your point number 2. And the third
Yes.
part, which you told about
Investments written off.
investment written off. Like this investment report written off, that we are following in line with the accounting standard 13, that whenever it is you are classified as a long-term investment, and if you find a major reduction, or you can not a major, I will use the word permanent diminution. That means the fall, which is not ever going to reverse it. That written off part, where you are supposed to disclose in your financial statement. So for that, again, let me take you to that Excel only to give more clarity. That you are supposed to refer it to the other expense. Here we have other expense. Is it Excel is visible, no, ma'am?
Yes, sir, it is visible.
Under
It's
the other
viewpoint.
expense, yes, you may provide it under the other expense as a permanent diminution in the value of investment. Here you can see this point number. Provision for the diminution in the value of investment.
Right, sir.
Is it fine, ma'am?
Yes.
Yeah. So let me summarize one. What provision for the bonus would fall under the employee's benefit in the year in which it is paid. Provision for the income tax relating to earlier year will go on the face of the P&L. See the Excel sheet, that is a first page where you are supposed to write all the numbers where this provision of the earlier year would fall. Coming toward the investment written off, that you are supposed to go to the other expense, and under that you have a separate head where you can provide this loss. Over to you, ma'am.
Rajesh sir, what would be the treatment of interest expense and interest on partners, members' capital in the statement of profit and loss? And should they be separately reported in the statement of profit and loss account? Sir, you are on mute.
Sorry, ma'am. Actually, interest expense is the main line item in the statement of profit and loss account on the face. Any interest paid on partners or members' capital, it should be separately disclosed in the statement of profit and loss account, but it should form part of finance cost in the notes to the financial statement.
All right.
It should not be disclosed on the face of the financial statement. It should form of a note under the name of finance cost, because finance costs, as we have already discussed, interest expense paid to banks,
yes, sir,
to others, interest on partners / members capital, it should be disclosed separately, and other borrowing costs, applicable net gain loss on foreign currency transactions and translation. This we are talking about interest on partners members capital, which should be separately disclosed within the note on finance cost. But as regards partners remuneration is concerned, remuneration paid to partners is concerned, it is a separate line item on the face of the statement of profit and loss. This is the difference between the remuneration paid to the partners and the interest on partners or members capital. Partners remuneration on the face of the statement of the profit and loss account, and the interest on partners capital as part of finance cost.
Right, sir. Bhaveji, if you could enlighten us on how the interest on taxes is to be classified. Should they be classified as taxes, other expense, or finance cost?
Okay. Like as you told about interest on taxes, so I assume that it is the taxes which you are talking about, that is your direct as well as indirect tax. Like sometimes in depositing the direct tax, we are getting delayed. So that 234B, that income tax provision, the interest would be levied. As well as coming towards GST also, the indirect tax, there also the depositing of that tax, if it is delayed, then you pay the interest. So now let me take something out of the accounts for some few seconds. Like that interest which you pay, I would say that it would be a violation of law. Hence, for the purpose of income tax, it would be disallowed while you preparing your computation of income and you are deriving your tax liability. Coming towards that interest in the books of accounts. So I have an option that should I add it to the tax provision which I am making? Should I consider it as an other expense? Or should I consider it as a finance cost? Because the word is being used as an interest. The word which is being used is an interest. So for the purpose of classification, I would say it would come under the format of the finance cost as an interest. But for the purpose of income tax, you may disallow it while deriving your tax liability for the income tax provisions.
Right, sir. So then it is considered as a part of my finance cost.
Yes, ma'am.
May I add? So,
yes, sir, please.
Guidance note on Schedule 3 to the Companies Act also.
Yes.
This is being included as a part of finance cost.
Yes,
under Section 234B, C.
Yes.
All these interest paid are part of not part of provision for taxation, direct tax. It is not a part of current tax as such. It is a part of finance cost only. Taking the same clue we can conclude here that this interest paid should not be taken as part of current tax. It should be part of finance cost only.
Yes, yes. Thank you, sir. Thank you, sir. In addition, that is also correct. Yes.
Bhaveji, we've already discussed on foreign currency, but in case of borrowings in foreign currency, how are the
Okay.
gain and losses on foreign currency fluctuation to be reported in the financial statements?
Okay. Yes, ma'am. Now you asked about the gain or a loss on the foreign currency fluctuation. So now, if you permit me, can I take one small illustration with the numericals
Please, sir.
to explain this gain or loss?
Yes, it would be more
Yeah,
clear.
but for that I need your help also for calculating some amount also. So are you ready for that?
Sure, sir. I
Okay.
hope it's not a math wizard.
Yeah, just help me with the certain numbers. Is this Excel sheet is visible, ma'am?
No, sir. As of now, we can just see the folder.
Is it visible, Excel sheet?
Not yet.
Not yet. Okay. Yes, now?
Yes, sir.
Okay. Yes, now see, as the question is talking about the foreign borrowings. So now see, is a foreign borrowing. So now I want to refer some of the standard also. Like we have accounting standard 16, which is talking about a borrowing cost.
Yes,
As well
sir.
as we have linked this with the foreign exchange. So I would like to interlink AS11 also, that is your foreign currency transactions. So we will take one foreign loan, we will calculate interest, and we will calculate interest as well as the foreign exchange loss or a gain, and then we will see under which all are the place this interest as well as that exchange loss would come. I hope I am on your correct question.
Right, sir.
Yeah. So let me take one a small example on this foreign loan. Like assume that you have taken one foreign loan of US dollar 1 lakh, and the exchange rate is 45. So I would say equivalent to rupees.
45 lakhs.
45 lakhs. Very good, ma'am. 45 lakhs. So you are with me, and I hope everybody
Yes.
will be with me with this example. So I got 45 lakhs equivalent to rupees. Now the rate of interest which I have to pay is assume 5%.
Right.
So my interest component in terms of the dollar, because see, I have taken a loan in dollars, US dollars.
Dollars.
So my
Yeah.
obligation first I have to calculate in dollars. So
Dollars.
can I say
5,000. Yeah.
5,000? Very correct. Now I have to make a payment in rupees because I am located in India. So I will convert this 5,000 at the exchange rate prevalent on the date of payment. So like assume that exchange rate on the date of the payment is 48. So my interest obligation equivalent to rupees that
2,40,000.
2,40,000. Is it fine?
Right.
Yes. Now 2,40,000 rupees of payment that I will make, that is my interest component. Accounting standard 16 will come about the borrowing cost. Number one. Second thing, that I have an obligation to make a repayment of the principal amount also, which is 1 lakh, but I am not making payment now. So this $1 lakh will appear in my balance sheet as my financial liability.
Yes, sir.
At what value I have booked my financial liability is 45 lakhs, but on the closing date, at the time when I prepare my financial statement 31st March, the rate is 48. So now a liability will also increase.
Yes, sir.
So I have to restate my liability. And how much I have to restate? That is my $1 lakh. And exchange difference will come. That is a difference between 48 and 45. That is 3 rupees.
45.
So 45 I have already booked. Now I have to book 3 rupees more in order to restate my liability, which will give me an exchange loss. That will be your 3 lakh rupees.
3 lakh.
So now, if I say, what is my total expense on this foreign borrow?
Interest.
And interest is 2,40,000. Other is your exchange loss.
Change loss.
That is your 3 lakhs. So my total is 5,40,000.
Yes, sir.
Is this format and the calculation is very fine, ma'am?
Yes, sir, it is.
So now I hope your question is coming on this 3 lakhs.
Right, sir.
Your question is on the 3 lakhs,
Yes.
that how it has to be reflected in the financial statement.
Yes. How do we disclose this?
Yes. So now see this interest, I will name it here as accounting standard 16. And this 3 lakhs, I will name it as accounting standard 11. That is your foreign exchange loss or a gain. But now, let me add something to your question, that this 5,40,000 which I have, should I debit this 5,40,000 entirely to the P&L account as in format of the financial expense? In format of the financial expense. So I would like to add something in your question, that let me introduce accounting standard 16 also in this, and to identify that out of 3 lakhs, should I transfer that 3 lakhs rupees entirely as exchange gain, or should I take it something to your accounting standard 16 as a borrowing cost? Because see, as and when you say borrowing cost, that does not allow you to debit your interest expense to the P&L, but it makes you to capitalized. It makes you to capitalize. So let me just introduce something more content in this. Like assume that instead of foreign loan, if I would have taken this loan from India, then how much loan I would have taken? I have taken a loan of 45 lakhs rupees, equivalent to the foreign borrowings. So if I place here loan equivalent to US dollar, I would have taken 45 lakhs rupees of loan. What was the exchange rate of interest in India? Assume that it is 11%. So interest will come. Yes, ma'am. Interest will come as 4,95,000. So can I say this is your maximum interest of 4,95,000 would have been allowed by the standard if you have taken loan from India. But as you have approached to the foreign loan, where the rate of interest is lower, so they can't restrict you. They can't restrict you only till 240, but they may allow you maximum 4,95,000 as an borrowing cost under accounting standard 60. Is it fine?
Yes.
Yeah. So now let's come to our question, your question, and something which I have added in my part, that now how the treatment of that interest and the exchange loss will be given. The total expense which I had is how much? Is 5,40,000 actual. 550 which I have, 2,40,000 is the interest, and exchange loss is your 3 lakhs. This is your maximum to be allowed, 5,40,000, because this is your real transaction. This loan taken from India is only for the purpose of comparison. So foreign loan interest which you have, which will be allowed to be capitalized, is your 2,40,000 pure interest cost. Pure interest cost. Exchange loss to be capitalized, not as an expense, but it will be capitalized. How much it can be capitalized? That what was your total allowable expenditure was for 4,95,000. In that 240 you have capitalized. Still they will allow you to capitalize the difference of this, which is your 2,55,000.
Right.
So this 2,55,000 is a part and parcel of this 3 lakhs only. So now a balance which you have, that will be allowed to be debited to your P&L account, will be your 45,000. That is your 3 lakhs minus 255. So this 45,000 balance exchange loss debited to your P&L account, and this will be shown as your finance cost. 45,000. Let me summarize, madam, this question. You
Sure,
have
sir.
asked me about an exchange loss. That is your accounting standard 11, which is talking
Yeah.
about an exchange loss at the end of the year. Just restate your liability and transfer whatever that exchange loss is coming to your finance cost. Under that, there is a head is available, loss on foreign exchange translation. So that is your question. That would go directly. But in
Yes.
this, I have just
Well,
mixed up two elements, which is AX16 as well
16.
as AX11. That out of
Mhm.
exchange loss, something can also be capitalized rather than transferring 100% to your finance cost. That bifurcation would be done in this design when you are approaching foreign borrowings. When you are approaching foreign borrowings.
Alright.
I hope, ma'am,
Right.
this example is very
Yes,
fine
sir.
and you
This
also helped me.
example, yes, sir, it explains it well.
Ma'am, may I add something to this?
Yes,
Please,
sir.
sir.
So it is not the case that the straightforward this amount should be capitalized. Sometimes foreign borrowings are not to made for the purposes of a qualifying asset.
Yeah.
Yes.
First and foremost criterion AS16
This
borrowing
is
case
qualifying
capitalization
asset.
is
Yes, sir.
that the borrowing has been incurred for a qualifying asset. If the
Yes.
asset is not a qualified asset, then this amount will straight away go to the profit and loss account.
Yeah, then the entire amount
Correct.
goes to profit
Yes,
and loss.
they
Correct,
has to
sir.
be parked at two places. One as a finance cost and another as a exchange difference on foreign currency transactions and translation. Foreign
Correct.
currency transaction and translation is to be disclosed in the other expenses, and the finance part is to be disclosed under the finance cost. Because
Yes,
it's not everywhere that we borrow foreign borrowing is always for the qualifying asset. It can be the case that a non-qualifying asset which does not as per which there is a rebuttable presumption that any asset which take a period of 12 months or more, it is a qualifying asset. But in any case, if it is a borrowing for a non-qualifying asset, you cannot capitalize that amount to the asset.
Yes, sir.
Rajesh sir, actually Bhaveshji did not want it to be a vanilla question. So he added toppings to it. But anyways, it did add to our knowledge and to the question itself. So
Yes,
moving
yes.
on to the next question, Rajeshji. How the non-operating income and non-operating expenses should be presented in financial statements? Should it be netted off or should they be shown under separately under income and expense head?
Ma'am, as we have already discussed that the other non-operating income should form part of other income in the financial statements. That is below the revenue from operations, it should be a part of other income in the statement of profit and loss account. Other non-operating income should be disclosed net of expenses, net of non-operating expenses directly attributable to such non-operating income. Suppose in case of rental income from property, any expense incurred on that property like repair and maintenance of that property, that should be netted off for the purpose of disclosure of other non-operating income. Income from share trading, income from mutual funds, any expense directly related to that income should be netted off from the other non-operating income to be disclosed as other income. However, there may be case when non-operating expenses do not generate any non-operating income. Such non-operating expenses should be separately disclosed on the expense side of the profit and loss account under the head other expenses. Over to you, ma'am.
Right, sir. So anything in case of a non-operating income, any expense that we've incurred directly to earn that income, we will net it off from that income and show it in the financial statements rather than disclosing them separately. Bhaveji, should depreciation on property, plant and equipment and intangible assets be disclosed separately in notes to accounts? Or they can be disclosed as a single line item on face of the profit and loss account?
Yes, ma'am. Like as you told about property, plant and equipment and the intangible asset. So I want to add one word in that. Like we use the word depreciation on the property, plant, and equipment, but as and when we come to the word intangible asset, we use the word called as amortization, which is in line with the accounting standard 26. So we have two words, a depreciation and the amortization. Depreciation apply on the PP, amortization applies on the intangible asset. So whether that would fall, the total amount, combination of PP and the intangible, that would be shown on the face of the P&L, or it has a separate location in our format of financial statement. So now, for that, let me take it into the Excel only to give a more clarity on this. Like this is it visible now, ma'am, Excel?
Yes, sir, it is visible.
Yeah, see now if you see the expenses under that point number D, we have depreciation and amortization expense. So this depreciation would apply, the depreciation would apply on your tangible assets and amortization would apply on your intangible assets. So here a single amount would come. By adding all this both, you are supposed to show it on the face of the P&L, but you might be having a separate gross block of asset for tangible as well as intangible assets separately. That you may show it, but the total amount would go on the face of the P&L under this expense, depreciation and amortization expense.
Thanks.
Over to you, ma'am.
Rajeshji, how would the government grants or donation received be disclosed in the profit and loss statement? Rajesh says. Bhaveshji, till the time Rajesh sir joins back. Oh, I'll move on to you. And how in the same question, if I continue.
I'm here, ma'am. Sorry.
Achha. No worries.
Yeah.
So I'll go to you. How do we disclose the government grants and donations in the profit and loss statement?
This government grants and donation, these are to be disclosed separately, but this guidance not on financial statements of non-corporate entity does not give us separate guidance. This is to be taken from the accounting standard 12 on government grants. For presentation of government grants, accounting standard has prescribed two broad categories for accounting treatment of, which is one is capital approach, under which a government grant is treated as part of the shareholders fund. And the another approach is the income approach, under which a grant is taken to income over one or more periods. In fact, there are different forms and formats of a government grant for which different accounting treatments has been prescribed under AS 12. One, first of all, is when there is a government grant relating to property, plant, and equipment. Government grant, in this case, if it is related to a specific property, plant, and equipment, this should be presented in the balance sheet by showing the grant as a deduction from the gross value of the asset concerned in arriving at their book value. Or alternatively, the second approach is that the government grant relating to depreciable items of property, plant, and equipment that may be treated as deferred income, which should be recognized in the profit and loss on a systematic basis and a rational basis over the useful life of that asset, in regard to which that government grant has been received. Such grant can be allocated over the period and in proportion in which depreciation is charged on that asset. Means the amount of depreciation charged in the profit and loss, the proportionate amount of government grant in relation to that asset, that should be credited to the profit and loss. As regards grants relating to non-depreciable assets, when a government grant is received in relation to a non-depreciable asset, that should be credited to a capital reserve under this method. However, if a grant related to a non-depreciable asset requires the fulfillment of certain obligation, because every grant received from a government carries some obligation to be fulfilled, then this grant should be credited to income over the same period over which the cost of meeting such obligation is charged to income. The deferred income balance in this case should be separately disclosed in the financial statements. In this case of non-depreciable asset means the deferred income will go in the balance sheet. And this is a government grant relating to depreciable asset and the non-depreciable asset. If a government grant relates to the revenue part, or the grant relates to expenses incurred or the losses incurred. Government grant relating to revenue should be recognized on a systematic basis in the profit and loss statement over a period necessary to match that expenses. Such government grant should be either be shown separately under the head other income, or it can be deducted from the related expenses to compensate which the government grant we have received. And
Thanks.
certain government grants are in the nature of promoters' contribution, like central investment subsidy or the state investment subsidy. There is a scheme from the central government that if you put up a unit, this much of the capital contribution that will be contributed by the central government in the shape of subsidy. These government grants should be credited to the capital reserve and should be part of the owner's capital. There are some other formats of government grants, such as government grants in the form of non-monetary assets, grant receivable as compensation for losses, grant receivable for compensation of expenses, for which different accounting treatment has been prescribed under AS 12. Over to you.
Thanks. So, Bhaveji, in continuation of a previous question on the property, plant and equipment, so any profit and sale of property, plant, equipment, how should they be disclosed in the statement of profit and loss?
Yes, see, now coming toward the sale of property, plant and equipment, like it is not the main agenda of the company, to sell their equipment. So I would not say it would happen frequently in nature. And it would not be the like a sale of goods. So this sale of property would arise only in certain situations, like the asset has become obsolete, you need to replace the technology. So at that time, it is possible that sometimes you sell part of your asset, or the asset has become old, or you want to replace the asset. In that case, you would be having some carrying value in the books of accounts. You will realize some portion, and whatever that profit or a loss would come, it would be a minor in nature. It would be an ancillary in nature in terms of addition to the main revenue. Hence, that would be classified as other income. If it is a profit, if it is a loss, then you may classify under the head other expense. But under that, let me add something, that like you have an asset of assume 1 crore in your property, plant and equipment in your entire factory, and one day you decided that let me sell all property, plant and equipment. That is also will be identified as sale. If you are selling a part, is also a sale. If you are selling everything, that is also a sale. But that would give a different identity now, because now your question will come on your going concern, that you do not want to continue your business, hence you want to sell all your property, plant and equipment. In that, you have to give a call to your AS5, exceptional and the extraordinary item, that it is now not in your normal case you are selling your property, plant and equipment. It is in the case that you want to shut down your business and you want to sell your all property, plant and equipment. Then it would not fall under your other income and other expense. It would become, and you have to refer for AS5 for that. Else you may continue, just a minor profit or loss would arise as other income or other expense in your profit and loss statement format. Over to you, ma'am.
Rajesh sir, a guidance note on non-corporate entities prescribes different reporting of partners' remuneration, and same is also not included as a part of the employee benefit expense. So how do we disclose this, and also do we include any kind of contributions made by the partners to different funds?
Yes, ma'am. Since contribution to provident fund and other funds and the gratuity expense is a separate line item under the employee benefit expense prescribed under this guidance note.
Yeah.
To my mind, only the contribution to provident fund and other funds and gratuity expense relating to employees of the entity should be disclosed under the employee benefits expense. then the partners and the expenses of such nature like provident fund and other funds and gratuity contribution relating to the partners of the firm should be included in the partner's remuneration, which is a separate line item on the face of the statement of profit and loss account. You see, if it would have been the case, then the remuneration to partners would also have been included under the head employee benefits. This is the only reason that employee benefits expense does not include the remuneration paid to partners, because of the contribution to provident fund and other funds and the gratuity amount paid to partners should not be clubbed with other employee benefits expense. It should be clubbed with partners' remuneration, which is to be disclosed on the face of the statement of profit and loss.
Right, sir. Bhaveji, in case of an accrual system of accounting for proprietorship, is there any requirement to provide for expenses like gratuity, income tax, deferred tax?
Okay. Ma'am, you were talking about gratuity, income tax, and the third point was
Deferred tax.
deferred tax. Okay. So here you have two type of taxes. No, one is income tax and the deferred tax. But before that, madam, you have asked about a proprietorship. So now see, a non-corporate entity, under that a proprietor can also be there, a partnership firm can also be there.
Yes.
So like, some few days back, I had taken one a seminar on the non-corporate entities applicability of AS. If you permit me, I want to just show you one or two slides on this proprietorship as well as the applicability of this AS.
Please, sir.
Yeah, let me share that one or two slides.
Yeah.
Is it visible, ma'am?
No, sir, not yet.
Okay, okay. Let me reconnect once again. Yes, now it is visible, ma'am?
Yes, yes, yes.
Yes, see now, in the guidance note, they have not told about proprietor, partnership or like that way. They have classified the entity under different levels, like level 1, 2, 3 and 4. So for that, I'm just taking one or two slides for your better reference. Yes, so majority, the levels are being classified under this level 1, 2, 3 and 4. So now if a proprietor is there, partnership is there, AOP is there, if they are falling under this level, which are your turnover and the borrowing criteria, 250, 50 crores, 50 crores, 10 crores, 10 crores, 2 crores, 10 crores and does not exceed 2 crores. So on the basis of this level, the applicability of the accounting standard has been designed. So like now, if you have asked me a question about the gratuity. So gratuity will fall under accounting standard 15. So now we are supposed to, I have a list of accounting standard. Let me go to the accounting standard 15. So here, if you see employees benefit, it applies to all the levels. That is level 1, level 2, level 3 and level 4. So now on the basis of that borrowing and the turnover criteria, this employees benefit will apply to everybody except that level 2, 3 and 4, there are certain disclosure exemptions are there in terms of the presentation. So accounting standard 15 would apply to the proprietorship if it falls under level 1, 2, 3 or 4 anywhere. Is it fine, ma'am? The gratuity?
Yes, sir. Yes, sir.
Yeah. Now let me come to your second point, which is your income tax and the deferred tax. Yes, let's see that next slide, which is your accounting for taxes. That is also applicable to level 1, 2, 3 and 4. So now AS 22 is also applicable to all levels. So your proprietor might fall under level 1 if the following criteria, level 2 or level 3 or level 4. Now, coming toward that accounting standard 22, taxes on income. No, there are certain classification, timing differences there. Result of that, a deferred tax, or you have to provide for the income tax. So accrual principle would apply even for proprietor once it falls under level 2, level 3 and level 4. Level 1 would not be applied because it is for a different entities. So
Nice.
AS15 and AS22 is
22.
supposed to be highlighted on the basis of that level. Under that, proprietor may fall under any of the category.
Yeah, so in both the cases, the level 1, level 2, level 3, level 4,
Yes.
irrespective of the level, the standards are applicable to all the entities.
Yes, yes, ma'am. But for AS15, there are certain disclosure exemptions are available. That is why I marked it as yes, and there is a star is there. Some disclosure way you are been exempted to give it in the notes to account. That is for level 2, 3 and 4. But for level 1, employees benefit would apply perfectly 100% with all disclosure and necessity. Over to you,
And sir,
ma'am.
continuing with this only, that how do we report profit or loss on discontinuing operations and the tax implications on it?
Okay. Yeah, ma'am, can you repeat the question once again?
How do we report profit loss on discontinuing operations and the tax thereon?
Okay. So see, now the discontinuing operation, for that also we have a separate standard, which is your accounting standard 24. So 24 is talking about a discontinuing operation, that sometimes a major product or one of the factory unit you have planned to shut down in the current year, and in that case, for some period you might have continued. So for some period you must have gained something. You have to pay the tax also. As you are told, discontinuing, that means you must be selling a certain major amount of property, plant and equipment. So under this guidance note, we have a format of the P&L account where it speaks about that you are supposed to show it on the face of the P&L, all the transaction related to the discontinuing operation. Let me share the Excel and to give more clarity again on that. Is it visible, ma'am, this Excel?
Yes, sir. Yes.
Yes. So now see here, we have profit or loss from the continuing operation. After that, you have this profit or loss from discontinuing operation. You are supposed to write directly that profit or a loss. You are not supposed to take expense, income and all this thing. Work it out in the backside, take that profit amount and write it on the face of the P&L, tax expense. So that here they're supposed to pay the tax, that you are supposed to show it separately, and then you will get profit or loss from discontinuing operation. So on the above part, you have continuing operation, discontinuing operation. This is your accounting standard 24. The presentation and disclosure, you may refer it, but in your format of the financial statement, this is the location at which the discontinuing transaction has to be reflected. Is it fine, ma'am?
Yes, sir.
Yeah,
Very
over
clear.
to you, ma'am.
Rajesh sir, two golden words which always bring smile to all of us is auditor's remuneration. Do we have any requirement for classifying auditor's remuneration under different subheads, both for non-corporate entities or LLPs?
Yes, as per the prescribed illustrative format for profit and loss for the non-corporate entities. The other expenses of the profit and loss include one line item, auditor's remuneration, refer note below. The note below item has not been prescribed under the illustrative format, but it can be inferred from the auditor's remuneration, refer note below, that different components of auditor's remuneration are to be disclosed subhead wise, whether on the face of the other expenses or as a separate note to the financial statement. Auditor's remuneration like audit fee, fee for other matters, reimbursement of expenses, these are to be separately disclosed, and the consolidated amount is to be disclosed under the head other expenses.
Right. So anything that as an auditor, or even if we are doing any representation matters, has to be grouped under the category of auditor's remuneration.
That, but separate disclosure is required, that whatever you are getting as an audit fee. Means most of the cases, it will be a tax audit fee. In case of non-corporate entities, it will be audit fee under Income Tax Act. Fees for other matters, maybe representational matters, the reimbursement of expenses, then certification fees. We are supposed to issue certificates which are required by the statutory. Then it is to be disclosed under a separate group.
And sir, could you please take us through the extraordinary items that need to be separately reported in the profit and loss account? Bhavesh ji, if you could please take us through.
Yes, ma'am. In some previous question also, I used the word called as extraordinary item.
Yes.
Over and above that part. But now let us take the definition of the extraordinary item. Pure definition, we can say, how you classify that particular transaction which has happened, you would say that this would be an extraordinary. And whenever, see, there is an extraordinary, it has to be shown separately with some decoration. It can't be merged and shown anywhere. Otherwise, it won't become extraordinary. On a lighter note, I am telling, but let's come back to the accounting terminology. Whenever we say extraordinary, they are using these two words. That whenever these characteristics of these two conditions are present, you may treat that as an extraordinary and show it on the face of the P&L. Like how we have shown as a discontinuing operation, same way, extraordinary item, either it would be a favorable or an unfavorable in nature, that has to be shown on the face of the P&L. So let me come to that two conditions that we have for the extraordinary item. One is your any transaction which is unusual in nature. Any transaction which is unusual in nature. And number two, it is infrequently happening. Unusual and infrequently happening. Then any loss or a gain arises would be reflected on the face of the P&L as extraordinary item. For example, like we can say a natural disaster. It is unusual as well as infrequent. Every day it is not happening and it is unusual in nature. Earthquake, damages by fire, losses from the early repayment of the debt. Sometimes you make a prepayment of the loan and for that you are supposed to pay certain charges also. Then that would also fall under your extraordinary item because that is not your normal finance cost. Now it would not fall under your finance cost, but you may treat it that. If the amount is material, then you may treat it as an extraordinary nature. So on a nutshell, I would like to highlight two conditions once again, that is your unusual in nature as well as infrequently the transaction is happening, then you may classify under the bracket of extraordinary and show it on the face of the P&L as extraordinary item, either favorable or unfavorable in nature. Over to you, ma'am.
Rajesh ji, if you could let us know on how prior period items need to be disclosed.
Yes. Prior period items, these are governed by Accounting Standard 5, which defines that the prior period items are income or expense. It can be income because any item which is a prior period, either it can be income or expense, which arise in the current period as a result of errors or omissions in the preparation of financial statements of one or more earlier periods. These errors, which have to be taken as prior period item, these errors may occur as a result of mathematical mistakes while applying accounting policies, misrepresentation of any facts, or oversight. There may be an oversight which could result in error. As a result of this error, any income or expense arise in the current period, only then this expense will be treated as prior period expense. There may be certain items of income or expense though related to prior periods, which arise in current period. For example, arrears payable to workers as a result of revision of wages with retrospective effect during the current period. This kind of item will not be treated as a prior period item because it is not a result of mathematical error, mistaken implying accounting policy, or any misrepresentation of fact. It is only that today we have decided to pay the arrear to the workers with retrospective effect. As such, the prior period item should be distinguished from a change in accounting estimate, because sometimes we change an accounting estimate, and by the result of that, we change item of expense income or expense incurred during the previous periods. Accounting estimates by their natures are approximations that may need revision as and when additional information becomes known to us. For example, income or expenses recognized on the outcome of a contingency, which previously we could not estimate reliably, it does not constitute a prior period item. Because prior period item is specifically defined that these items should arise during the current period as a result of error or omissions only. As regard their presentation or disclosure requirements, the nature and amount of all the prior period items should be separately disclosed in the profit and loss statement in the manner that their impact on the current profit should be properly perceived. There are two approaches to it. Prior period items either can normally be included in the determination of the net profit or loss for the current period with a separate disclosure. An alternative approach can be that you show such item in the profit and loss after determination of the current profit and loss. In either case, whether we show it as before current profit or we show within the profit and loss count as a separate disclosure, the main objective behind it, that if there is a prior period item, the effect of such prior period item should be properly disclosed, and so the user can drive out at the current profit and loss other than the prior period. Over to you, ma'am.
Sir, like you mentioned about the accounting estimate. So how do we report the effect of change in the statement of profit and loss?
The accounting estimate, we need not to disclose it separately. As already told or already contained in the accounting standard 5, accounting estimates are merely an approximation. If we, as regards any provision which we make or as a liability which we create on the basis of an estimation, because some information is not known to us at the time of preparation of the financial statements, we have to provide that liability. Then approximation is a part of preparation of the financial statement. But if after the date of preparation of the financial statements, any new thing comes to our knowledge, then we next year we have to change that estimate, and that will not become a prior period item. That any item arising out of this change in estimate will form part of current year's profit only.
Right, sir.
In that case,
And
sir,
sir,
we can say it is a prospective effect for the estimate. Yeah. And for the prior period, we can say we need a restatement of the financial statement would arise.
But
yes,
for accounting estimate, we can say effect would be prospective.
But for prior period item, even restatement of the financial statement is not required. Only the impact on the current year's profit is to be disclosed. Either we disclose within the current year's profit and loss as a separate line item, or we first drive out the current year profit. After that current year's profit, we disclose the prior period items.
Okay, sir. Okay.
And Rajesh ji,
prior period does not warrant the restatement. Prior period item, it has to arise. It has to arise. That does not mean that we have to redraft our financial statement or restate our financial statements.
Oh,
okay,
of course.
Sir.
Rajesh sir, what are the criteria to determine point of recognition of revenue from a transaction involving sale of goods or export of goods with respect to transfer of risk, reward, and ownership?
Yes, accounting standard. I'm audible?
Yes, sir.
AS9 talks about the revenue recognition. Revenue from a sales transaction should be recognized when requirements as to performance under the transactions are satisfied. Provided at the time of performance, it is not unreasonable to expect ultimate collection. The main criteria, first of all, is that to recognize performance under the transaction should be. This is the foremost requirement, that performance should be satisfied. If we talk about revenue from sale of goods, performance should be regarded as being achieved when one of the both the following conditions have been fulfilled. The conditions are: the seller of goods has transferred to the buyer the property in goods for a price, or all significant risks and reward of ownership have been transferred to the buyer, and the seller should not retain effective control of the goods transferred, which amounts to a degree usually associated with ownership. And the second condition is: no significant uncertainty exists regarding the amount of consideration that will be derived from the sale of goods. These two limbs define how and when the performance should be regarded as being achieved. The property in goods should have been transferred, or all the risks and rewards of ownership have been transferred to the buyer, and the buyer should not have effective control of ownership. A key criterion for determining when to recognize revenue from a transaction involving the sale of goods is that the seller has transferred the property in goods to the buyer for a specified consideration. The transfer of property in most of the cases results or coincides with the transfer of significant risks or reward of ownership to the buyer. However, there may be situations where the transfer of property in goods does not coincide with the transfer of significant risks and rewards of ownership. In these situations, the revenue should be recognized only at the time of transfer of significant risk and reward of ownership to the buyer. Means property in goods, even if transferred, that should not be the criteria for revenue recognition. Only when the significant risk and reward of ownership have been transferred to the buyer, at that point of time, we should recognize the revenue from sale of goods. Suppose we are selling the goods on X factory basis. As and when the X factory, the goods are out of your factory, at that time, you can recognize the revenue. But if the goods are not on X factory basis, they are on delivery basis, that unless and until the goods reaches the premises of the customer, the risk and reward remains with the supplier. In that case, you can recognize the revenue unless the ownership is not transferred. The risk and reward of ownership is also not transferred to the customer. So the risk and reward is the most important criteria to recognize a revenue involving the sale of goods, and same is case with exports. If you are in case of exports, your risk and reward transfers at the time of bill of lading. Unless and until the goods reaches the stage of bill of preparation and bill of lading, you cannot recognize the revenue. Till that ownership remains with the supplier, the goods will be considered as in transit and will be considered in the statement of balance sheet and the profit and loss of the supplier only till that date.
Right, sir. Sir, with respect to AS11, which prescribes the reporting of monetary items at closing rate and non-monetary items at transaction rate, could you please explain the monetary and non-monetary items, Bhaveshji?
Yes, ma'am. Like the example that I took it in the Excel, where you have also helped me in the numericals. If you come across that the restatement of the liability of that $1 lakh that we have done,
Yes.
so that borrowing would be identified as your monetary items, and hence we have restated that with 48 rupees in the referring to that example. So that we are supposed to restate as a closing rate, which are appearing in the foreign exchange. That is on 31st of March. Coming toward the non-monetary items, then we'll take the definitions. A non-monetary item like you have acquired a fixed assets by taking the foreign borrowings. Then that fixed assets also the invoice must be raised in dollars. That also you are supposed to convert. But now that fixed asset is going to be there with you for a longer period of time. So every year you will not restate your fixed assets. It would be recorded once at the transaction rate. That would continue for the upcoming future till the time that asset is there. Share capital is there. Other part of the reserves are there. If you have a foreign branch also. So we translate them at the transaction rate. So in a summarized format, can I say a monetary item like you took foreign borrowings, we might have foreign creditors also, like those items which we can convert into cash or a near cash term on a shorter period of time. Or you can say it is your liquid asset also, that would be considered as a monetary items. And non-monetary is like your, I told you, fixed assets, inventories, long-term investments, that would appear to be as your non-monetary items, and that would be translated at the closing rate, at the transaction rate, and monetary items would be translated at an closing rate on a respective balance sheet date. Over to you, ma'am.
Rajesh ji, what are the criteria to determine whether forward exchange contracts are covered under AS 11 or not?
Yes, ma'am. AS 11, the effects of changes in foreign exchange rate is applicable mostly to the all type of forward contracts, including those entered into to hedge the foreign currency risk of existing assets and liabilities. This AS 11 is also applicable to any kind of forward exchange contract intended for trading or speculation purposes. But this standard has specifically excluded two types of forward exchange contracts that accounting standard will not be applicable to these type of foreign exchange contracts. In this case, where the exchange differences arising on forward exchange contracts entered into to hedge the foreign currency risks of future transaction in respect of which firm commitments are made or which are highly probable forecast transactions. Two types of forward exchange contracts which are made in respect of a firm commitment or which are made highly probable transactions. These kind of forward exchange contracts are not covered by Accounting Standard 11. Accounting Standard has also defined the term firm commitment and the forecast transaction. As for AS 11, a firm commitment is a binding agreement for the exchange of a specified quantity of resources at a specified price on a specified future date or dates, and a forecast transaction has been defined as an uncommitted but anticipated future transaction. Suppose you have an export order or import order in your hand, which is uncommitted, but that can be considered as an anticipated future transaction. If you enter into any forward exchange contract in respect of such kind of uncommitted but anticipated future transaction, or where there is a binding firm commitment, these kind of forward exchange contracts are not governed by AS 11. AS 11 governs forward exchange contracts for trading purposes or speculation purposes, or forward contracts included the contracts entered into to hedge the foreign currency risks of all the existing assets and liabilities. So these are all from this AS 11 as regards forward exchange contracts.
And sir, the concluding question to Bhaveji and to you both are, what are the main differences in the format of statement of profit and loss of non-corporate entity and LLP?
Yes, ma'am. In the first question only, you asked me about the brief format of the profit and loss account.
Yes.
So now in the last, now you want that both the format has to be given, and let's see what we can highlight as a difference. So let me just recap the first question, where I hope this was the part.
Yes, sir.
Can you see this Excel sheet?
Yes, yes, yes.
Yes. So now see continuing operation, discontinuing operation, tax expense, all this part of questions you have nicely covered in our entire webinar, and we have highlighted wherever it was necessary. So this was your a non-corporate entity. Other than LLP, this format has been presented. Profit before tax, continuing operation, and discontinuing operation, and last you get the total profit for the year. Now, let me go to the LLP format. Same way, financial statement for the LLP. Yes, now, ma'am, this is visible?
Yes, sir.
Yeah. So this is your LLP, where the same way, same pattern would fall, like revenue from operation, expenses are there, before exceptional, extraordinary, you have covered that question, that also we have seen. But see, now the word is coming, profit before partners remuneration and tax. That was not there in the non-corporate entity, because in LLP you will have a partners also. So here one more addition of that partners remuneration would come in your format of the P&L, else that format would go in line with both the similarity. So partners remuneration would fall on the face of the P&L under your LLP case. Other than that, if you see, the similarity would be the same. That is about your comparison of the format between non-corporate and the LLP which you have asked. That is a main difference you can say in connection to your format part. Over to you, ma'am.
Right, sir. So we have a question from the audience, and the question is that if we receive a perquisite of foreign travel from a customer and our TDS is also deducted under Section 194R, whether this income has to be reflected in the profit and loss account?
This 194R is a bonus benefit. If it is given to us as a customer, or our supplier has given us as benefit of foreign travel, this should form part of the bonus income, because this is in relation to your bonus income only.
And we have another question from a member, but I think we've already answered this question. He wanted to know, in case of a proprietorship, they are maintaining personal account for business purpose, how to record the transaction related to business and non-business, and its presentation in FS. We already did discuss this at length, but would you like to summarize it again?
Might be the case that this participant might not be there at that time when we have.
Yes.
No, Praveen ji, I have seen that Praveen ji have raised this question.
Yeah.
Praveen ji, this format of financial statements is only for the business entity. If there are personal items in the financial statement, that will not give a true and fair picture of the results of the operations of the business. In that case, any saving account or his personal mutual funds, personal FDRs of the proprietor, that should not form part of the financial statements of a non-corporate entity. Non-corporate means a proprietorship entity in this case.
And so we have another question on, please guide the treatment of insurance claim received for material loss.
This has to be. Okay, sir, go ahead, sir. Please go ahead.
No, sir. Yes, sir.
No, sir. Please.
Yeah. Like, about the insurance claim, that would be related of two items. One is either of inventory, or either it would be of property, plant and equipment. Like if any fire has happened, and assume that you lost the WDV of the asset 1 lakh rupees, which is appearing in our books of accounts. Now you have filed an insurance claim. So a thing might happen that till 31st of March, there is no confirmation is received from the insurance company that we will pass your claim. So we have two questions in front of us. The number one is the WDV of asset 1 lakh, which we lost. Insurance claim is pending. So you are supposed to see the outcome of that insurance claim. Like assume that so far no outcome has arisen, then you may reduce the value of 1 lakh and you may show it that at least I will receive 1 lakh rupees of insurance claim and that I will show it as a receivable. It would form part of your other income. Once the claim is finalized, you may net off and show it as a net amount. Till the time, you may show it as receivable, provided the outcome is positive that you are expecting. Over to you, ma'am.
So I think this brings us to the end of the webinar. And it was a pleasure moderating both the stalwarts. Thank you so much for sparing your precious time. Over to Pramod, sir.
Thank you very much, Nitika. In fact, today's session was very enlightening, and I have seen the comments of various participants who have really gained a lot from today's session. Thanks to both the panelists, Rajesh Jainji and Gondia Saab, and of course Nitika for moderating these two stalwarts, and thanks to Shalini and the whole team of ASB for organizing such webinars and keeping this series live. Again, to all the members, that in this series, all the 3 webinars are there available on the ICI website, on the ICAI TV. It is all there. So anyone who wants to see, they can see it anytime. And I'll request you that you tell all your other colleagues to go through these webinars and ensure that this year, when the financial statements are prepared for the non-corporates, proprietorship partnerships, LLPs and others, they should have the formats which has been notified by the ICI, not only for proprietorship, partnership, LLPs, but also for the NPOs. And again, which has been told in our earlier webcast also, webinars also, in this also, that these Excels of these formats are available on the ASB website. You can go to the asb.ici.in, asbici.org, and there you can, along with the standards, you will file the Excel sheets along with the guidance notes. So anyone could go to the ICI website or ASB website and use that. And again, thanks to each and every participant who have joined to have this knowledge sharing session. Thank you, everyone. Thank you very much. Thank you.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, Ma'am Nitika ji, to be
Thank
a good
you so
moderator
much,
for
sir.
this session. Thank you, ma'am.
Thank you.
Thank you, Vivek ji, for sharing
Thank
guys.
you. Thank you, everyone. Thank you very much, sir.